All right. Um, in today's video, what I want to do is show you or go through a process that I typically use with new investors. And, to me, I didn't realize this was that important for the longest time. I kept trying to force alternatives onto people. And then I backed up and realized something I've got to go back and help these people get their mindset correct because alternatives are really they're different. Alternatives are called alternatives because they are not Wall Street. Most of us are indoctrinated into this Wall Street thinking. Even as children, I remember in school when we played the stock market game in, I think it was seventh or eighth grade, and we competed with other students and we picked stocks, and you were given a make believe $10,000. And I think you played this game for the entire semester, maybe from August through December. And at the end, you had winners, and everybody celebrated the winners. And then sometimes you would take risk. I remember betting on penny stocks and not winning that competition at all. But when I get on the phone with an investor, I'm usually trying to. I have to overcome this mindset very frequently, a mindset that Wall Street is where all my money's at. Why should I move any of it to Main Street? Why should I move any of it to alternatives? The first thing I tell them is if you don't know who Tiger 21 is, Tiger 21 is a group of considerably wealthy individuals. They network together, they come together, they meet, they compare portfolios, they consume information together, they bring in their guest speakers, and they're an investment club. Most of us don't have the means to join Tiger 21. That's why I kind of created my group, my Smart A Investors. But what we can learn by looking at Tiger 21 is where are these ultra wealthy? So I think you have to have a net worth of north of 20 or 30 million to be in that group. Where are these investors putting their money? Why are the middle class being told to put their money in a certain and we've got these gurus that are telling us where to put our money, how to invest, put it in stocks, put it in index funds for 30 or 40 years, and no regard to fees, no, just set it and forget it. And even people talk about passive investing. I hate that word. I hate the word passive investing. But in essence, when you're participating in a syndication, you are passive. The reason that a syndication exists is the SEC says if you don't have an active role in a deal, then that's a security. And that's why we have syndications. So, but I'm trying to change this mindset of Wall Street's the only way to do it. And these things that appear under the roof of a financial advisor, which may be bonds, stocks, maybe even REITs, maybe even a little bit of commodity funds. If you walk into your financial advisor and you say, I'm thinking about doing real estate, they are going to try their best to keep you under the roof. And they're going to show you this real estate investment trust that goes into emerging markets. And this is where and those returns are not as robust as they can be. They're keeping a cap on you. They're killing you with fees. And the reason I started this group is give people access, give you immediate access, ownership access to assets that can double or triple what you're getting in the stock market. And when I say that, if you're getting 8 to 10%, I can show you deals that can easily get you 15%. But we're looking to double and triple. So I'm talking about 16 to 24%. Very common to see that on um, some of the deals that I consider safe. You can easily get 15%. I have a deal right now I'm working on that is going to throw off a 20% return every year with very little debt. And debt is where your risk comes in. And these guys leverage very rarely and very small when they do leverage. And that gives you unbelievable returns. But again, let's go back to what I have to overcome when I'm on the phone with a brand new investor. I'm going to talk about these things. And the first thing we've got to talk about is clarity. Clarity. I've got to figure out where they are. I've got to be clear. Where are they with their finances? And it is amazing how many people don't know this. And I'm guilty of that. I used to be a set it and forget it guy. I would just put my head down and go to work and make sure that 401k was funded. and set it and forget it. You pick the index funds maybe once a year, or not, maybe once every 2 or 3 years, that you're picking these funds. You're not really looking, but you're looking at the big number at the bottom of the balance. Right now, people are enjoying pretty good returns on a stock market that I can't explain. But clarity says, where are you at right now? And are you happy, or do you feel comfortable there? I can't imagine being heavily invested in a stock market in mutual funds where you have 7 or 8 companies that are propping up the S&P 500. And if you don't believe me, look at it. It's these technology, it's Google, it's Facebook, it's Apple, it's Tesla, I think it's Nvidia, and there's a few more that are propping up the S&P 500. So what you've got to get is clarity. What is it you want? If you think your 401k and your bonds and investments, if you're clear that they are good enough to get you there, if the 8-9% returns are going to get you to your goal, and you've got 10-15 years, you're within sight of retirement, or down, whatever we want to call it, working less. If you've got the clarity that that's going to get there, good for you. But I want to help you get this clarity of what it is you want. If you want a lifestyle that's equal to or better, then we need to get that down on paper. We need to know that. We need to know what the number is. Is the number $100,000 a year? Is the number $250,000 a year? With inflation, that things have changed. I don't know if you saw this the other day. Some guy found a receipt where he had bought 20 or 30 items at the store in 2021. I forget the exact amount. I'm thinking it's 60 or $70, and these are all over the internet. He went back and bought the same 20 or 30 items, and the cost of those items is almost double. But your government's telling you inflation's under control, and it never got more than 7 or 8%. Yet tell me how a receipt from 2021 to today, it takes twice as much money to buy the groceries that you're getting. So make sure that you build in inflation for what you want your lifestyle to look like. If you're certain that that's not going to be a problem for you, great. But I would challenge that you need to, if you're living comfortably on $250,000 a year, okay, and don't buy into the lie that once the kids are out of school, once all these things are done, that you're going to be spending less money, because you know what, you're probably not. You're probably going to downsize to that home on the lake or the golf course. If you want to see your grandkids, you better have some cool things at your house, or have a house worth attracting your grandkids back to. Swimming pools, land where you can run four-wheelers and go-karts and fun things. If you don't have that, then your grandkids aren't going to come see you. That's just a little bit of a tip for you. So clarity, where are you and where are you going? That's huge. Trying to think if there's anything else on clarity to add to it. I don't think there is. So the next thing is certainty. Okay. So once you've got clarity, then you got to be certain that you know the path you're choosing. Okay. Clarity is, you got to do something and you're choosing a path. Certainty is, are you choosing a path that you know can get you there? Okay. And this is a big one, because a lot of people say, hey, I know alternatives are good, but there's a lot of risk in real estate. Or I don't really want to be a landlord and deal with toilets and tenants and termites. And you know what? That's true. I've done that. 25 years ago, I started that path of toilets, tenants, termites, and I've come to the realization that a passive position where I place my money and bet on expert sponsors and expert operators is where I'm at, and where I want to get my investors to a point where that's where they want to be. Very few people are cut out to operate commercial real estate. But for whatever reason, I see tons of engineers and tons of doctors and people quitting their jobs to go deal with termites and tenants and toilets. Okay. So, certainty, can this get you there? And what I want to help you do, I want to help you realize that yes, alternatives certainly can get you there. And the way we're going to do that is true. You know this word because it's used all the time. Okay. It's used all the time. You hear this in the stock market: diversify, diversify. True diversification means the first thing you got to do is get a portion of your assets off Wall Street. Okay. So you got to get uncorrelated from Wall Street. That's your first level of diversification. Then you got to get that half of that of your money diversified across multiple asset classes. Now you're going to hear people tell you diversification looks like an apartment building in San Antonio and an apartment building in Nashville, Tennessee, and an apartment building in Atlanta. You might even hear somebody say an apartment building in San Antonio, an apartment building in Dallas, and an apartment building in Houston. That's not diversification, okay? True diversification is how we get certainty, and true diversification looks like a mobile home park in Tennessee, a apartment building in North Carolina, a self-storage facility in Mississippi, an industrial flex deal in Kentucky, an oil and gas deal they drill in what mine is in Wyoming. That's what true diversification is. That's it. And if you look at Tony Robbins has written a book called The Holy Grail of Investing, and in there, Ray Dalio says the Holy Grail is 8 to 10 diversified, uncorrelated assets. Okay. And that's how we get true diversification. Once you get this vision and you see it's possible, because most people get hung up here and say, how do I get that? How do I learn enough about apartment buildings? They start off on the journey. They start off trying to get there. And so they go to a conference, a weekend conference, and they meet a bunch of people. There's 500,000 people in the ballroom of the hotel, and they're learning how to syndicate real estate. They're syndicate apartment buildings. That's how the past 10 years have operated. And now some of those people are getting it handed to them because they didn't diversify. They didn't learn they learned everything they needed to know, which really, about apartment buildings or whatever. But now the market has shifted. Apartment buildings may or may not be a great investment, depending on the buy price. That's what it's about. There's so much competition, it's driven prices up. Interest rates come in and kicked people in the you know what. And now we're seeing multifamily properties lost. And it depends on what happens with interest rates. You got a lot of people holding their breath, crossing their fingers, everything, hoping to get through 2024, survive till 2025, and refinance. Okay, I got news for them. They're not going to be able to refinance at the rate they bought in at, and they're more than likely going to lose those properties, and more likely those investors are losing that. But once you get your clarity and your certainty, and through true diversification is how we achieve certainty. Okay. And what I want you to see though is I'm promising, I promise people 15+%. Okay. And that is a really attainable goal. The way you get there is, in the baseball analogy, you're hitting a lot of singles. Let me just tell you, the stock market, you're just bunting all the time, occasionally hitting some singles. But in this, you're going to hit some singles, doubles, triples, and home runs. We're going to be placing bets on operators, well vetted sponsors, assets, and operators. We are doing all that due diligence already and placing those bets in good markets, taking in the macro market of what's going on in the world right now. And we're placing those bets and we're trying to hit this. You know what? Most of the time we out achieve this. We go over that because I'm getting ready to, I've been vetting a deal for the last month that it pays 20% with very little debt, very little risk, and it beats these multifamily deals with so much less risk. And that deal's coming to my investors over the next week or two. We will raise for that and we'll button that up real quick. But my investors will put a safe asset, a safe investment in their portfolio that's probably going to give them 20% a year for 5 years. It's probably going to double their money in 5 years, maybe quicker. We also negotiated a return of capital within the first 24 to 36 months. That means my investors will come in with $100,000. That $100,000 will earn 20, 40, 60. Then the 100 comes back, and then they'll earn 60, 80, 100, and then the entire investment has come back, and they've doubled their money in 5 years. But the cool thing is when that first 100 comes back, when that return of capital comes back, which is on top of the 20, 40, 60, they can go deploy it again in 3 years. The internal rate of return of that deal Even though the average annual return is 20%, the internal rate of return on that deal is north of 30% for my investors. That's how we get certainty through true diversification with playing these deals. We'll play some debt deals that pay about 10 to 12% very safely. They're a first position note. But then we'll take a swing with some equity deals. Right now, a few months ago, we took a swing with an equity deal on a marina that we think can 3x capital in a short period of time. So we take those swings trying to get that. So once you've got this clarity and certainty, the next thing just comes easy. And the word is, trust. But you've got to trust the process. Okay. Now, a lot of people think when I say trust, they're talking about me, and that's true. In order to invest or trust somebody to invest, to guide you through some investments, you got to know, like, and trust the individual, the sponsor, and that's what we aim to do with all of our assets. Um, Knowing them is one of the biggest things. I have dozens of operators across asset classes that you probably never even heard of. Okay, so we pride ourselves in meeting as many people. I'm in masterminds, I'm in all kinds of going to these conferences and conventions, meeting operators, getting to know sponsors, people that have done deals. They've done them a lot, they have a track record, they've seen bad times, they've got some gray hair. You got to trust you got to trust those operators, and the way you do that is through critical due diligence, scrutinizing the worst parts of the deal. They're going to come to me and say, Kent, we got a deal that's killing it, and I'm going to say, tell me where the risk is. And they're going to say, well, we stress tested against this. I ask the questions that find the warts on that deal, the worst part. But once you know all this is in place, you can trust this process. Okay. You can trust that you have truly diversified. By trusting the process, you're committed to knowing that some of these are going to be winners and some of them may be losers. We're mitigating the risk of losing, but it happens. But the beauty of this, and just like on the stock market, they tell you to keep dollar cost averaging, buying when it's low, buying when it's high. We're always buying right, making sure our sponsors are buying right. But when we do that, the process works. When you are spread out and truly diversified over all these asset classes, if some of them are just meeting pro forma, they're throwing off 12, 15, 20%. Okay. Sometimes they don't meet pro forma, but they're still throwing off 5, 6, 8, 10%. And the ones that outperform the conservative underwriters, they're giving us numbers and they're outperforming those. And they're the ones that are hitting 20, 24, 28% average internal rates of return. And they can return your capital quicker. And then we roll that money over and do it again. Not to mention, we're always on the lookout for tax incentivized deals, ways to save on taxes, um, and trying to marry those two things together to alleviate the tax burden. You can also invest inside an IRA, a self-directed IRA. I suggest a solo 401k for those of you that have your own businesses. Getting that set up, you can avoid all kinds of taxes and fees if you set that up correctly. Ask me about that if we end up on a phone call. But this is what I'm going to take you through, is to make you see that this is how it lays out. This is how the process plays out. But at the end of the day, you got to engage the market, and you can't just dibble dabble. Okay. You can't just invest in one or two things. That's not true diversification. If half is in one thing and half, that's a 50% risk of your portfolio in two assets. You've got to be able to spread your money out across this. Sometimes we can lower minimums on these investments and get people diversified better. But what I'm talking about is for the accredited investor. It's typically for people who have $250,000, $500,000 to move into alternatives. And if you're not quite there, we can still talk about that. And also you need to be an accredited investor, look that up, know what that is. But this is the process. This is what we're going to talk about on the phone. If that resonates with you, then I'm going to ask you to consider joining our group. What does our group do? If you join the group, you get education, you get group access, you get training, but what you get is access to the Smart Flex Fund. And through the Smart Flex Fund, that's the vehicle that I'm able to bring alternative assets that have been expertly vetted by me, but not just me, my peers who are experts in self storage, apartments, all mobile home parks, together we have this collective knowledge. We vet deals, we know the questions to ask, we source deals, which good luck. I used to try to source deals on my own. I tried to do all this on my own. And until I realized I've got to become part of a team that can do this. And sure enough, now I'm seeing deal flow like never before. And for my own investments, I'm investing right alongside my investors. I'm seeing deal flow like never before. I'm passing up great deals, but I just am waiting for the better deals. And I feel like we finally hit one. We just underwrote, we're ready to raise, and we'll be going this week public with the raise on that, trying to hit a 500,000. We're getting great economics if we can get a 500,000 or more. And I know we'll get the 500,000 because it's not all on me. We've got a pool of fund managers trying to raise that. We're probably going to hit 2 or 3 million. If I was guessing, we're going to hit that. We're going to get the best economics that this sponsor has to offer because we're making it easy on them to raise the capital. They just need $3 million. Well, I've got 6 or 8 friends along with myself together. We're going to raise that for them. We're going to blow them away, and they're going to be able to do what they're due. They're going to take their asset class. They're going to be able to double or triple what they've been doing, and their track record shows no sign of slowing down. And when we fund them, they will be able to go after bigger deals, and they turn money over 2 to 3 times a year, which means it's like a cash machine. And if you want to hear more about that asset class, check out some of my other videos, and you'll see what I'm bringing to my investors. So if this at all resonates with you, comment below, reach out. Let's talk about investing. I'll run you through this process. We'll see if you have clarity, certainty, and then once you have those, then it's up to you to figure out, can you trust this process? Some people freak out. It's the same people that pull their money out of the stock market when it's going down. The ones that are running out of what they say, when they're running out of the building, you should be running in. We've got to get your mindset for these investments right before you play in this game. So I hope this helps you to maybe start thinking about making that transition. Maybe you already have. Maybe you've been burned in one of those deals I'm talking about, one of those multifamily. I would love to talk to you. I love to just kind of help investors analyze, not to rub it in, but let's find out where things went wrong in that deal. You may already know. More than likely, it's related to interest rate hikes. But I want to show you how good due diligence and teamwork could maybe have seen that. I pulled out of the market several years ago because we saw the warning signs, especially in hot markets. Where on these best and final deals, there was too much competition and there were too many people that had to do a deal. Okay. If you have to buy, that is the worst position to be in. So let's get on the phone. I'd love to just analyze what might have went wrong. I'd love to hear about the investments you've made. Hopefully they're not all going sideways, but I can show you how we can make it so much um, safer. I want to use that word, how we mitigate risk as a group. And I think that this will be a no brainer once you understand what we've built here with the Hickory Creek Smart Flex Fund and with the Smart A Investors Group. So just comment below. Let's get on a call, and I'd love to have a conversation with you today. Have a great one.